11:33 a.m. Pacific Standard Time. Date 9/25/2001. Beautiful Sunday. What I am going to show that I've done enough analysis on the S&P for the MMTs. I'm going to show a couple of things. Number one, I'm going to show that the 10-week moving average keeps going down through all of the weekly upside volatility. And I said in many other trainings that we buy the volatility go up, but as long as that 10-week moving average was declining, that every upside volatility had to be sold short. And you can see that this last week, this is triple witch, quadruple witch week. Okay, this is last week, this is the week before that, but notice that the sellers were much greater in the weekly reversal than the buyers on the bottom up. The 200 week, 1146, that's this number, period. All right, 10 week moving average, the number has dropped to 1199.64 in the S&P. The prior week, it was at 1217, so it's dropped in value, and that's why this bottom, 52-week calendar low bottom, is going to be weak. Now, having said that, we're going to take a look at the call side and the put side of imbalanced, inflated versus deflated. So I'm going to go over here now, and I'm going to show you a $1,200 call that within last week's range was $50 a contract. We were buying the $1,200 call down here right above the $12 area because they put a short-term big reversal in, and moving tomorrow morning is that the S&P is going to hold the MMT market maker weighted buy and sell transaction between buyers and sellers, and we want to go higher in volatility. Like I showed on the weeklies, that these calls are getting very cheap, and they closed at $16. It's already, and the high was $17.50. They opened at 12 and they went up to $17.50. You have 10 contracts in here, you just made $5,000 to the upside. Now let's take a look at the shorter term run right here. Let's take a look at this burn rate. Make sure it's in the video. You can see it. That's a 1220 put that has broke out higher. When we broke down up there at the highs of the market, we were buying the 1220 because it wouldn't take out 1220 on the S&P. It wouldn't. Now, let's take a look below the market here at a $1,200 put. And this $1,200 put was where we were buying it in the live videos because this was the cheapest side of the market. And we came in here, and the low side of this put was to be bought when the weekly and the daily reversal was that these could have been purchased down here, and I'll show you the purchases. They were $35 here on the low. Over here, they were $32.80 on the low per contract. So let's say you bought one contract, and it went to a high up here to $100 damn dollars. Well, you just made about 70 points. If you have 10 contracts down in here, at 32, so let's say you paid $35,000 for 10 contracts, and you're cashing in up here at $100 a contract, or at $98 or even $95 a contract. You just made one heck of a move in 3 days. Yeah, you did. Why? Because they were inflated over here at 101.50, and we got down to areas that were tradable here at 37 back to 74, and you'd come out during these trend cycles on the $1,200 put. You know, when the markets are when the put side is peaked over here at, let's say, 84, and we're coming back down here to 35, but the call side just got brutalized. And this is a contract that expires in 10/22. Right here's that one there, and here's that same call right here. And in the options market and market weighted trends, as you get in balance. So we peaked up here at the very high. That's overbought. That's inflated. Just like I show everybody about how to make market between inflated and deflated. That was inflated, pal. You seen what happened last time. Because the S&P trades, and they got down here, and this is where that put side, short side, needed to be bought and cashed in. Now, the call side, that's the weekly. And we went up to 1220 up here, and we had a big weekly reversal. But let's take a look outside of that weekly. let's move right back over here to the call side of the market. That's this side of the market. We're at a low. So during the pullback in the S&P to 1114, closes at, somebody told me the S&P closed at 1136.43. And it's trying to get a bottom, and this side can get cheaper, but it's where you want to start making this transaction. We making the transaction because if I'm going to stay the course here, if I'm going to stay short, and I'm taking some money off the table up here, I'm buying this side of the market because this side is deflated. This side is inflated during, and these are daily cycles. That's a 3-day cycle, for crying out loud. What a fortune there, and what a big drop down here. But this is where we're going to buy. Now we're going to be looking at this particular contract, and we're going to be watching the S&P and the market maker platform because I can buy up and out of the money $1,200 call. In order for that to work, to go higher up here, up in this area, that means that this put option, the $1,200 put, the S&P has to travel higher, and this will drop down in this area. And so there's a trade to the upside here, and there's a pullback over here relative to the intraday trading on the S&P. Let me not mention, I'm going to mention this. This is the fear indicator called the volatility index, the VIX. And when fear, the time to have puts is when fear is breaking higher here, and it's a 60-minute level at this lower line. But you can see that the fear came all the way back up here to peak levels, but it did not take out the last high right here. It did not. It came up to it and it started to reverse. That's when the put side of the market went down. And when the volatility fear goes down back in value, then that means that this $1,200 call is going to go up in value, meaning that the fear factor didn't take out here. I'm sorry, the fear factor did not take out the all-time highs. And if the fear factor remains to come down, then we are going to simply go lower in the fear. We go higher in the calls, and the puts come down because they do. So it's very coherent that we're understanding exactly where we're at. The weekly fear factor that's the high. All right. Now, when this was going up to the highs, markets were selling off last week, and when this was going down the prior week, markets were making all-time highs in the S&P. So the fear level still elevated, and we did not put a blow-off top in. What do I mean by a blow-off top? Is that if we were to break higher up here to 60, then that means that the S&P is naturally going to break down into the 1060 handle, 1080 handle. But we're consolidating the upper end of the fear. There's still fear in there, but when fear comes back down here, then that means markets break higher. If fear goes back up in this area, then we're going to break the 52-week low. We put a blow-off top in fear, and it comes back down. The markets will put a bottom in. The calls will go down in value to a great entry if that should happen, meaning that we have not had a blow-off top. But if we continue to go down in the next 5 days, starting on Monday, and we start to drop in the weekly fear indicator, that's going to support this up and out of the money $1,200 call entry. And that means that this overvalued put at the $1,200 price is going to come back down because it's inflated and they can reach an extreme. But when they do get up here, I don't care when, they're coming down. And so that's the inflated value of the $1,200 put. The call is cheap. So it just depends on what happens in this weekly fear. So if we break higher, naturally the put will go up a little higher. But then the call side, the $1,200 call is going to go down in value. Not to mention that other values in here are going to get lower in the chain here. And these are just up and out of the money. I'm just gauging the call and the put side. The 1220 put, we've been watching it. And we will also add various other strike prices in the S&P 500 that will trade. And I'll start throwing some of them in here now that expire on the 10/22, which is next month. Okay, that's the monthly. And I'm going to start putting in here for MMTs. What I will do is I've got some below the market that expire next week. If we take out the lows next week, I'm going to be watching what these put options do here on the 1060 and the 1090 and how much money that 1095 call would lose, how much that 1100 put would still get a little bit of value because that's the lows of the year on the 930. And then on the 930 is 1120 put because they would go up in value from here. And the 1120 call that we'll be monitoring in the next 5-day period, we would shoot and they would lose value. So I'm going to add some more contracts to this S&P 500 as to how it's going to be traded. And what I'm going to do on the October contract is I'm going to put in a 1170 call that we would be looking at, and I'm going to monitor the imbalance between the 1170 put and that 1170 call. Okay, we close at 1136. I'm going to take a look at the 1150 call up and out of the money because they're going to run really fast, and I'm going to put that 1150 put in there. So I can see what I'm doing with my 1022s here. Call, there's my puts. Here's some of my puts, and here's some of my calls. Okay, now I want to make sure that we get the 1170, we got the 1150 up and out of the money, we got the call, we got the put and the call, and we're going to monitor them. And we're going to figure out how to get weighted, because if the weekly fear indicator goes down in value, then we go up in the calls and the puts come down. It's going to be that simple. And once again, I'm going to go to page save, MMTs, and you can take a screenshot MMTs. So, hopefully it doesn't kill. So you'll have these new set of contracts, and we'll set alarms on them. How to trade the S&P 500 index. Knowing where the fear comes down and you go higher, or the blow off top and the blow off bottom, what the support levels are, how the actual trend is weighted overall in the yearly 52-week low pattern.